Okay. Good morning. Happy Friday. Hopefully you can all hear me. I'm kind of looking through. Some people don't have their cameras on. Please turn your camera on if you have one. That's always something that the state would like us to do. So I would appreciate it if you turn your camera on. And then make sure that you're keeping track of the keywords so that you can get credit. So don't get to the end of the class and be like, I didn't know I was supposed to keep track of the keywords. Make sure you're keeping track of the keywords. So you can either, I'll put this in the chat. You can either click on this link in the chat and go to the Google form, scan it with your phone, or you can email me at the end of class. But either way, keep track of words. And we'll come back to this later if you want to just write down your words and then we can come back to it. Okay, what's going on with rates? I woke up this morning to not so great a news. Anybody else follow anybody and heard what's going on?
Looks like there's a lot of market pressure to have rates go up.
Yeah, there is. So bonds are supposed to sell today, and my guy said if you are closing anytime before July, he would recommend locking. After July, maybe you could float. So we'll see what happens. They don't always know, right? They're all just trying to guess what the market's going to do. But right now, rates are kind of hanging out in the mid sixes again. So
There's a lot of inflationary headwind coming too.
Okay, yeah. So we're gonna get some of that. So yeah, just kind of it's always good to know what's going on with rates and why they're moving and what you're watching and it's good to be able to tell your clients. But at the end of the day, now is always a good time to buy, right? So if you can afford it and you want to get a house, now's the time to buy. Only better time was 20 years ago, right? Okay, yesterday. Okay, so I'm not, there's not any money in the police officer grant. I left this on here. It was from, I don't know, last year when I taught this class. 20K assistant, there's still a little bit left there. We talked about interest rates. I had somebody tell me they were a permanent resident alien and they weren't. So remember again, FHA does not allow non-permanent resident aliens anymore. Okay, let's talk. We're going to talk about lending today. Feel free to ask me any questions. This is your chance to ask any questions that you've always wondered about lending, but we're going to talk through the matrix, and I put a picture of it in here. If you don't have one of my matrices, let me know and I'll get one sent to you or deliver one to you. These are always really good to have as a cheat sheet. I have them laminated every year because the loan, the maximum loan amounts go up, so I change them every year. But these are really good, and we're going to kind of go over those and see what you guys know. Okay, sure, Steve. Okay, so let me just take a picture of that before I'll look at you guys, because otherwise I'll forget. Okay. Um, Basically, we want to talk about the different loan types. So they're all up here. What do you guys know about conventional FHA, VA? Throw stuff out. As a seller's agent, what offer do you like to hear? Or do you like to get? Everybody likes what kind of offer?
Full price.
Okay. Full price. How about the loan type? Do you guys look at that?
Conventional.
Yeah, okay. Most people want conventional. Why? Give me some reasons why, as a seller's agent, you might like a conventional offer more than another offer.
It's easier to work with for sure.
Okay,
Yeah,
why is it easier to work with?
FHA will often have some additional requirements.
Okay. Okay, we're going to talk about some of those today. They might have some different things that you don't like. What's one of them? Give me the biggest one everybody's worried about with FHA.
The appraisal, right?
Oh,
Appraisal
okay,
required
what
repairs.
happens with the appraisal with an FHA loan? You get an
Sometimes there's required
appraisal.
repairs.
Go ahead, roll up, Rolando.
Sometimes there's required repairs.
Okay, are you gonna have that with conventional?
No.
Never?
Sometimes.
Well, they can
Not as
ask,
often,
but
right?
it's
We're
not
worried about it
required.
more. Patrick.
They can ask, but it's not required like FHA.
Okay, so but you might still on a conventional loan, a conventional appraiser still might call something out. If there's a hole in the floor or the water doesn't work or something like that, conventional is going to call it out too. So I always like to kind of push back just a little bit because we are worried about FHA appraisals, but for the most part, it's not a big deal. Now there are some times when it is a huge deal. For example, it's a big deal. It was a big deal during COVID when prices were rising within months, right? So you would have one month you know your house might be worth 100,000, the next month it might be worth 130. Okay, and during that time, prices were elevating so quickly that if you accepted an FHA offer, got an FHA appraisal, and then they fell out of contract, now what happens? That FHA
The
appraisal
appraisal
stuck with,
stays with it.
yep, thanks, Ashley. It sticks with it for how long?
6 months?
6 months. Yeah, good, down. 6 months. And over that 6 month, for the next 6 months, you're not going to be wanting to sell to another FHA buyer if prices are going up. Because now that appraisal's stuck there and you're stuck with that. So back then, when, now after the next month, your, your purchase price is now 130 instead of 100. And you're like, sorry, I can't accept an FHA offer because then I can only get 100 out of my appraisal. So it limits you as a seller. So there was a lot of people who weren't accepting FHA offers during that time. What were some of the things that happened during that time because of that? Did anybody get any offers that were conventional as a seller's agent? And then before closing, here, please sign this FHA addendum. Anybody have that happen? Okay, so there were some tricky things that people were doing. Um, I mean, some people felt like it was super ethical. Some people feel like it's not ethical. We're not here to talk about ethics today. But things like that start to happen, right? Because you got this FHA buyer, they can't go conventional. It doesn't make any sense. And yet they're having a really hard time getting under contract. Even conventional loans were having a hard time getting under contract. So just different times, different things are going to be harder to swallow for sellers, and you kind of want to know what's going on with that. Okay, let me make sure. Before I get off, I'll make sure I have everybody's emails that wants that matrix. Okay, so conventional has pros and cons, FHA has pros and cons, VA, USDA, and Utah Housing, right? There's certain times when these are going to work better for your buyers. And that's our job as lenders to make sure that we give them the best program, not necessarily your job as agents, but at the same time, it's good for you to kind of know the basics when you're talking to your borrowers. If you need to, right, as you're learning, you can always be like, hey, that's a really good question. I'll find out for you. Or call Eden and ask her. That's kind of more her area of expertise. I find myself doing that a lot with buyers saying, you know, that's your realtor's area of expertise. This is what I think, but that's more their area of expertise. So check with them before you make any decisions. Okay, so conventional, let's start there. What is the minimum down on conventional? You're gonna have people coming to you who are like, oh, I have to have 20% down to buy a house. I don't have a big enough down payment. Okay, Ashley says 5% minimum. Okay. Anybody want to counter that?
I think it's 3%.
It's how, wait, what did you say? 3%? Okay, yeah, sorry, I didn't understand. Okay, so 3% is the minimum if you are a first-time home buyer. What makes somebody a first-time home buyer?
Eso eres tú, sabes todo.
Say that again. Dallin, say that again.
Sorry, I was saying something to somebody else.
Oh, okay. I was like, that didn't make sense.
It was
I
Spanish.
gotcha. I gotcha. Okay, so no purchases in the last 5 years, not 7 years. It's actually the last 3 years. So if you haven't owned a home in the last 3 years, now some people have said, well, I'm not on the mortgage, but I'm on the title. You're a homeowner if you're on the title, even if you're not on the mortgage. Okay. So the last 3 years you haven't owned a home, you become a first-time home buyer again. And then you could put 3% down conventional. If you've owned a home before or in the last 3 years, your minimum on conventional is 5%. Now, one other rule on this that you need to be careful of right now, we have a lot of co-signers, parents who are helping out. A non-occupying co-signer, you're going to be putting down 5% instead of 3. So that's one of the other exceptions too. Okay. What about FHA, minimum down?
3.5%.
Good. 3.5. How about VA?
I think 0 down, right?
0. Okay, you can put money down if you want to, right? And that just helps with your payment and stuff like that. But they can go in 0 down. And it used to be that VA had a max purchase price, but they don't really anymore. It's fairly high. Sometimes, so you can pretty much buy whatever you want that you qualify for, but you'll end up with a little bit higher rate if you're above the conforming loan limit. So it'll be a high balance VA loan. So I have one right now that's 890. They want to put 0 down, and they're going to be up above that 832 700, and so they're going to, or 750, and so they're going to be in a high balance. It's about a 0.5% higher in the rate to be up above that. Okay, but they can still do 0 down. They don't have mortgage insurance. There's a lot of really good things about VA if you qualify for it. Okay, let's talk about USDA. That's another 0 down. Why aren't we hearing much about USDA anymore? I've only done one in the last 3 or 4 years.
Was it USDA for rural
Yeah,
area?
yeah. So there's less places, right? Saratoga Springs, Eagle Mountain used to be rural, so not very long ago, actually. Yeah, and so like there was more area, but also it's harder to qualify for that. So with our higher interest rates and higher purchase prices, their debt to income levels are lower, and most people are maxing out their debt to income right now. They're going up to the 45% to be able to get into a house. So we're just not seeing people whose debt to incomes are lower make too much money for the program. And then people who, are in that income bracket, they just don't qualify. They just don't have quite enough income. So I always look at that when I'm looking at, there's a lookup website. You can just Google USDA lookup and you can click in the addresses and see if it qualifies. Nowhere in Salt Lake County, south of Spanish Fork is USDA still. West of Eagle Mountain, there's still a few places in Eagle Mountain that will qualify. So you have to kind of enter some of the addresses in the lookup. North of Ogden, Logan doesn't count. So there's it is definitely a rural loan, and we still can do it, but it's more rare with the way that interest rates are and housing prices.
Mm.
Okay, Utah housing. Why some people hate Utah housing? Give me your opinion. Do you like Utah housing? Do you not like Utah housing? What are your thoughts?
It's good for people that don't have the ability to get a down payment together, but at the same time, they don't have any skin in the game. And I can't remember the other point I was going to make, but those are two.
Yeah. So there's some things about Utah housing that are super positive. If somebody doesn't have a down payment, but they have the income, it can be beneficial to get into the housing market now, right? Without having, and basically I always kind of tell people, okay, if you like a Utah housing, if you want to get into a house now, but you don't have a down payment, look into Utah housing. But then the biggest issue is you got to start paying down that second immediately. Kind of as if you were saving for a down payment, but you're doing that savings after because it's really hard to refinance when you have that second mortgage still. It's hard to sell when you have that second mortgage still if you need to sell. So I'm finding that what's another rule about Utah housing that makes it hard to move out of? Like, let's say right now I have some people who have a Utah housing loan, they want to sell, they want to buy a bigger house, they don't have enough equity to sell without coming in with money, and they can't rent it out. So remember that when people are, whenever I do Utah housing, I think it's a great program. I think it helps people get into houses, but I always tell them, make sure that you realize like you're going to be in this house for a little while. If you want to move, need to move or upgrade or whatever, you're going to want to have that second mortgage paid off and you can't rent it out. So this is not an investor's, get into a house 0 down, move on to the next one and rent it out. So I just try to make sure they understand that so that they're not surprised later when they're trying to sell and they don't have the equity, or when they're trying to move up and they can't rent it out. So I think it's a really good program. You just have to make sure people understand what they're getting into and what the restrictions are. There's 3 or 4 different programs in Utah housing. There's first home. So a first time home buyer is a lot lower rate. FHA, for second time purchases, and it's a little bit higher rate. And then there is a conventional program. A lot of people don't know because Utah housing usually follows FHA rules, but there is a Freddie Mac conventional program now with Utah housing, and that can be helpful sometimes with condos. So one way, they're not FHA approved or something like that. But the rates are higher. So for sure, rates are higher on Utah housing too. You're going to have a bigger payment, but I've also seen people back in COVID time, right? They got into a house 0 down. Within 2 years, they had enough equity to refinance at 15%. So there are times when it can be super beneficial. We don't always know when that is, but okay. Any questions about the loan types? We're going to go a little bit deeper into max party concessions. This is something you guys really want to know because you're going to be making offers. And right now I'm seeing almost all my offers have seller concessions. And so every once in a while I'll still see something with a multiple offer situation where there's no concessions, or they wanted to get a lower price and so they didn't get any concessions. They asked for a lower price. But for the most part, we have seller concessions. So when your buyers have conventional versus FHA versus VA versus USDA, Utah housing, you're going to want to know what the max you can ask for is. So that if you ask for more, we can always take it off the purchase price, right? So it's not the end of the world, but it's good to kind of know. So on conventional, for a primary home, less than 10% down, you can ask for 3% total. And that includes any money that you as the agent gives to the buyer and any money the sellers give in combination. Okay, it can't be more than 3%. And then if you put more than 10% down, then it goes up to 6%. So if you have a bigger down payment, you can ask for a little bit more. For investment properties, it's 2%. So remember when you're doing investments that it's a lower concessions. And that's for any of them. Doesn't matter how much you're putting down. Okay, the government loans are usually 6%, except for VA is 4%. So that's pretty easy to remember. And just know that we're going to be calculating that. Like I said, I've had some that come in with higher and we just take it off the purchase price. So it's not the end of the world to get more. There's some builders that are doing that right now, right? They're offering like 9%. And you go, okay, wait a minute, how do they do that? They take the difference off the purchase price. Okay, so conventional 3 and 5%, just to recap, multi-unit primary new rule. Who knows what the new rule is? So if you want to buy in a fourplex and you're going to move into it, it used to be that any 3 and 4plexes you had to have 25% down, but now if you're going to move into it, you can go in with 5% down. So 3 and 4% triplexes and fourplexes, you can get in with a little bit less down if you're going to move into it. So some of these young kids that are moving, that could be a really good way to get into an investment property. Investment conventional, technically you can put 15% down, but we're not seeing anything priced at 15%, and at 20% it's like almost a full point higher. So 25% is what we're recommending now for investments down payment. There are some non-QM products that you can do investments with now. So hopefully you guys know about DSCR loans, where if it cash flows, then you don't have to look at anybody's income. That's a nice loan, especially for some of these people that have 15 properties and they're self-employed and they don't want to go through the headache. Or sometimes your self-employment income doesn't look good and you want to file it lower so that you cannot pay taxes. And so then that's helpful in that situation too when you're buying an investment property. Still 25% down. Sometimes we can do 20. Okay, second home, 10% down. I'm not seeing a lot of people buy second homes lately, but second homes are 10% down. And then we talked about the FHA, VA, and all those too for down payments. Okay, let's talk about mortgage insurance just real quick so we're all on the same page. Mortgage insurance, conventional, at what point does it fall off? How much down so that you don't have to have mortgage insurance? 20% down,
20%.
downloaded sign language. Thank you, Rolando. 20% down. Okay, good. And some people are in the chat too. Okay, so 20% down. That doesn't mean you have to have 20% down to buy a house. I do still hear people say that, but just that you won't have mortgage insurance, which in my mind, if you're going to make your payments, is throwaway money, right? So it's really nice not to have to pay that. Okay, so 20% down. FHA is the life of the loan. So just remember that with FHA, you're always going to have mortgage insurance. It doesn't fall off. And I always tell people that when when they have an FHA loan, but if they're only putting 3.5% down, it's going to take them a while to get that 20% equity. And sometimes it really makes the best sense for them depending on where their credit score is. And we'll talk a little bit about credit scores and the differences for that too. VA doesn't have mortgage insurance. Unless they're disabled, they do have a funding fee that's added to the loan amount. The first time they use it, it's 2.15. The second time, it's like 3.2. So it's a decent amount of money depending on the loan amount that's added to their loan, but they don't have mortgage insurance. And
Eden,
then, go ahead.
could we go back to FHA for just one moment? I'm
Please.
sorry.
That's okay.
So what is the strategy, for example, on FHA to get rid of mortgage insurance? Could you at some point in the future, when they have 20% equity, do a refi and get rid of it using another FHA loan or a different loan, or what do you suggest?
You would only be able to get rid of it if you refinance, and you would want to refinance into a conventional loan. You can't get another FHA loan and not have mortgage insurance, no matter how much equity you have. It'll be a little bit lower. Like if you do a 15-year, the mortgage insurance is pretty low actually, but it's still there. And but yeah, like the only way to get rid of it is to refinance out of it into a conventional.
Great, thank you.
Yeah. Okay. And so that's another thing too, when people are in an FHA loan, if their mortgage insurance or if their credit score is kind of lower, then that's something I'm talking to them about. You're eventually going to want to refinance out of FHA and get a conventional loan when you have more equity. And so working on your credit score can be beneficial in the long run. Okay, USDA used to not have mortgage insurance, but it does now for the life of the loan. And same with Utah Housing, they follow FHA rules and it's for the life of the loan. So I'm definitely explaining that when we decide which kind of loan we're picking, but oftentimes people are going to refinance before it would have dropped off on conventional, and sometimes that's just the best loan for people depending on their situation. Okay, max loan amounts. Right now it's through 832,750 is the conforming loan limit. So anything above that, you're going to be into jumbo territory. So you'll hear people talk about jumbo loans, and that's any loan amount that's above 832,750 in Utah County and Salt Lake County. So different counties, you can kind of look them up if you're worried, but different counties have higher loan amounts. So for example, Wasatch has a higher, and Wayne County, Summit, some of those counties have a little bit higher. And 2 units, 3 units, and 4 units, the conforming limit is higher too. So by county, same with FHA, it's definitely lower. So right now in Utah County, 601,450 is the max FHA loan amount. And so sometimes people are buying bigger houses and we can't do FHA even though they've got a lower credit score. And so it gets a little tricky. Salt Lake and Tooele, 637,100, Weber and Davis, 744, and then Summit's over $1 million. So FHA does have different loan limits and they're based on the counties. There's not a loan limit for VA like I talked about before. So, but again, like I said, you're going to have a higher interest rate above the conforming limit. It'll be a high balance. And then USDA follows conventional, and Utah Housing, it depends on the program. So most of them follow FHA rules. Credit affects your interest rate a lot more in conventional. That's another reason why you'll see people do FHA. You get a lower interest rate, and it's significantly lower. Right now, we're in the high fives for FHA, we're in the mid sixes for conventional. So it's significantly lower. But if somebody has a really high credit score, then they're going to have a lot lower mortgage insurance with conventional versus FHA. And that's the other factor too. So right now we have somebody who they told me they were a permanent resident alien. We thought we could go FHA. They're not. And so we're trying to go conventional, but their credit score is lower. And so their mortgage insurance is through the roof unless they put a lot more money down. And so it may kill the deal. So mortgage insurance is a lot higher and it is very dependent on your credit score. Okay, so premium pricing. Anybody know what that is? You ever heard a lender talk about premium pricing? So when a buyer comes to me and says, I talk about which interest rates they can have, the lower the interest rate, the higher the fees, right? The higher the interest rate, the lower the fees. And so I can sometimes pay some of their closing costs by raising the interest rate and then getting that money for that loan in the secondary market because it's above where the level is. We're actually pricing higher than what rates are. It's not happening very often right now, but if somebody's super cash tight, we can do that and just have a little bit higher interest rate to cover their closing costs so that they're not coming in with that money. So that's called premium pricing. And premium pricing is allowed on most loans, but not on Utah housing. So you can't raise the interest rates to cover costs with Utah housing. Okay, so jobs. FHA, remember, we're going to have a solid 2-year work history. There's just really no wiggle room there. Conventional, sometimes I can get some wiggle room with a 1 year, at least 12 months is kind of how it says. We like to see 2 years, but if you have at least 12 months, then we might be able to make it work. Same with commissions and overtime. So conventional is going to be a little bit more lenient that way. But FHA has a little bit more stricter requirements that way. And VA is a little bit strict when people are switching jobs too. So we try to be careful with that. Okay, real quick before we move on, let's talk about derogatories on credit and wait times. This is a good thing to be able to know when somebody comes to you and says, I had a bankruptcy, or I had a foreclosure, or I had a deed in lieu, those kind of things. They may tell you, they may just tell me. But either way, it's good to kind of know the wait times for being able to buy a home. What about mortgage lates? This is a really good one. If you have a 30-day mortgage late on your credit, how long do you have to wait before you can buy a house? Longer than you think, a whole year. So mortgage lates are super big deal. I always tell people if you have to if you get into trouble and you have to not pay a bill, try to make sure that you always pay your mortgage on time because a 30-day late makes it really hard. You can't refinance. I have somebody who needs to refinance and they've got mortgage lates. They can't refinance. So you just have to be super careful with those and just kind of know that if that happens to you, you're not gonna be able to buy a house or refinance for a year. Okay, so there's 2 different types of bankruptcies. Chapter 7, where they wipe out all the debt. Chapter 13, where you go on a payment plan to pay it back. And so the wait times are, of course, longer for the Chapter 7, where they wipe out all the debt, than the Chapter 13. For conventional, you're going to wait 4 years for a bankruptcy. Chapter 7. Chapter 13 is 2 years. Foreclosures are 7 years, and short sales or deed in lieu are 4 years. So a lot longer wait times on conventional. You're typically going to see people who've had bankruptcies going FHA, partly because their credit scores haven't bounced back, and that's usually what we see as the problem is your credit score is bouncing back. But FHA is only a 2-year wait, and for Chapter 13 it could be as low as 1 year, but it's kind of a unicorn because typically their credit scores haven't bounced back that fast. Foreclosure is 3 years, and short sales are 3 years. And then bankruptcy is 2 years again for VA, and foreclosures are 2 years, short sales 2 years. So basically 2 to 3 years, if you just kind of have that in your mind, you're about 2 to 3 years before you can buy a house after a bankruptcy. And that's after the discharge date. So we have the ability to look those up and just figure out when the discharge date is so that we don't pull our credit or do any of that work before we've gotten past that 2-year mark. Okay. Just a reminder, you're keeping track of words. Let's do our first word. Let's do bankruptcy. So again, 4 out of the 5 words today. Bankruptcy is our first word. You can click on the link, scan the QR code, or email me your words. Okay, home types. We pretty much have a few different home types, right? We're either gonna be a primary where you're gonna live there. Second home. What's the definition of a second home? Anybody know?
Is it somewhere that you've occupied at least 14 days in the last calendar year? Is that it?
Okay, good, yes. So you have to at least be there at least 14 days, and then you can't long-term rental it, right? But you can rent it out short-term. Okay, and what's another rule about a second home? Can you buy a second home right next door to you? No, right? Why would you want to? Lower down payment, right? Like, okay, I'm pretending this is my second home and not an investment property, so I don't have to put 25% down. I can just put 10% down, right? So Brandon says 50 miles. You'll usually hear people say 100 miles from your home, but that's not always true because somebody might live in Provo and have a cabin at Provo Canyon that's not 100 miles away, and that can count as a second home. So it just has to make sense, right? Some people try to buy second homes for their kids to live in at BYU. Be careful with that. Your loan officer is going to say, this is an investment property, especially if you're renting it out to other people. Okay, so just know that there are some rules about that, and you're going to have to follow those rules for second homes. Investment properties, that's pretty self-explanatory, but there are a couple different kinds of investment properties. So we have a lot of short-term rentals right now. If you come into my office and you say, I'm going to buy an investment property and then it's going to be a short-term rental, what immediately happens to your loan? You can't offset that payment with rents as soon as you tell me that it's a short-term rental. Okay. So I can only offset rents with an investment property if it's going to be a long-term rental. So as soon as you tell me that, I'm like, oh, sorry, I can't offset rents. And what's one of the things about investment properties that's kind of nice? You can offset the rents on the payment to qualify, right? So just be aware of that rule and careful. Um, if you're gonna rent it long term and it's an investment property, you can, I'm buying an investment property. That would be a good way to state it. I'm buying an investment property, and then, we can say, okay, well, we can get a schedule of rents from the appraiser that can tell us, let's say it's $2,000. This is what the appraiser says this investment property will rent for as a long-term rental, and then we can offset the payment by that $2,000. And that helps significantly in qualifications. Okay, let's talk about different kinds of properties and loans. Condos is one of the ones that gets us in trouble if we don't understand how they work. They're a little bit harder to do loans on. The rates are a little bit higher. So what's the difference between a condo and a PUD and a single family residence and a townhome? What's the difference? Condo versus townhome, what's the difference? Let's just do those two.
Well, actually, they could be the same, just in general vernacular. But a condo, you own the interior of the building and then a percentage of the common area. With a townhome, it could be sitting on its own lot and you own the entire building and the land underneath it.
Thank you. Yep, that's a great explanation. So when you say that it could be the same thing, sometimes condos look like townhomes. So be careful. I've seen them listed as townhomes when they're actually condos. I had one where it was listed on the MLS as a townhome, and it was one of those end unit townhomes. That's how it looked. But when I looked it up on the county website, it was actually a condo. And the only reason why it was a problem was because that condo project was under construction and it didn't qualify for the loan. She was doing 10% conventional, so we thought, oh, we're still okay. But nope, it was a non-warrantable condo. She ended up having to buy it on seller financing. That was the only way she could buy it. And I didn't love that idea because she put 10% down, and where did that money go? To the real estate agents and to, right? Like it really didn't go into her loan the same way it would have in another way. So had she needed to sell it, it would be really hard to sell it, right? And she was a single mom. And so, but she said God told her she was supposed to buy that property. And so at that point, I'm like, everything's going to be fine, right? Like you can't argue with that. But you have to kind of be careful with condos. So just make sure, don't trust the MLS when you're working with your buyers on whether it's a condo or not. And I always talk to my buyers about, condos are a little bit higher rate and some of those kinds of things. And especially if they're FHA buyers or USDA. I did a USDA condo recently. They have to be either, USDA is kind of cool because they either have to be qualified or approved by FHA or VA. So if VA approves them, then we're okay too, even if FHA doesn't. And so in that case, VA approved it and that's all we needed for USDA. But if it's an actual FHA condo, it has to be approved by FHA. And if it's not, then we sometimes can do a spot approval, but those are a little bit risky. So anyway, just know if you're going with a condo, it could be a few more issues. And if you're going conventional with a condo, you might not have any issues, but there still are some rare cases where they're non-warrantable and they can't even go conventional. So townhomes, we don't have that issue. So they don't have to be approved the same way. And we can basically do the loan as the same as we would a single family residence. We just have the HOA and the transfer fees and some of those kinds of things. Okay, manufactured versus modular versus mobile. Make sure you know the difference between these three, okay? Mobile, you're going to the DMV, okay? It's like a car. It's not the same as real estate, okay? So you're going to go to the DMV to close that deal. And not most lenders don't do loans on mobile homes. There's one called 21st Mortgage. If you're doing any mobile homes, you want to write that down. 21st Mortgage is a really good one for mobile homes that can help your buyers. Manufactured versus modular. Modular is like stick built. And so kind of like a normal, so that's going to be a little higher quality. I haven't come across one that's considered modular, but manufactured can be regular loans as long as it's on a permanent foundation and comes with the land. So we just closed a manufactured home in Beaver, and we had to get a few extra things, an engineering cert, some things like that. But for the most part, it closes very similar to a single family residence, and just has to be built after 1976. So the really old manufactured homes, even if they come with land, you're not going to be able to get a normal loan. You're going to be doing cash most of the time for them. Okay. Any questions on those? Definitely not something to be scared of, just basically to understand and know that there are some issues that they could come across so that you can prepare your clients. Okay. So VA, USDA, and FHA all have upfront costs. And this is something I discuss with my buyers a little bit when we're just trying to decide which one would be, which program would be the best for them. So you might have a lower interest rate on FHA, but you have this upfront funding fee or upfront mortgage insurance fee that's added to their loan. And it's 1.75% of the loan amount. So it can be a decent amount of money, 10 grand or something that's added to their loan. And this isn't what it is, but I kind of tell people it's kind of like buying down the rate, but you don't have to come up with that money. It's just added to your loan. It's not really what it is. It has to do with mortgage insurance. And if you refinance within 2 or 3 years, you'll get some of that money back. But there are upfront funding fees for all of those. And we just need to make sure our buyers understand that, right? And that's going to be my job as the lender. Okay, again, VA, the first time they use it, 2.5. 15% of the loan amount, 3.3, unless they're 10% disabled. So if they're getting a disability, then a lot of times that fee is waived. And I'll get their DD 214 when they discharged from the military, and I'll submit that for a certificate of eligibility, and it will tell me if they have disability and if they have that funding fee. So that's all kind of behind the scenes that you guys don't usually have to worry about once you're under contract. VA doesn't have monthly MI, but it still does have that funding fee like we talked about. Conventional, 3 options. Okay, so I think it was Lynn that said, how do you get rid of mortgage insurance on an FHA loan? With conventional, sometimes when they're like, let's say they have 15% down, they could choose to buy out that little bit of mortgage insurance and not have mortgage insurance. So if the sellers gave some concessions, we could put that towards buying out their mortgage insurance and getting rid of that. But your options are to pay it monthly, to buy or buy it out, or to lend or buy it out if we did the premium price increase. But you just have to know that. And then once you hit 20%, it doesn't automatically come off until 78% loan to value. So you're going to want to request that at 80% because they'll keep it on there for a little bit longer if you don't request it to come off. So that's kind of an annoying little tidbit. Okay. What about escrows? If you don't like to have your escrows in your mortgage, which I don't know why people don't want to, maybe they like to use their money during the year, and so it's not just sitting in a non-interest bearing account. But you can choose to not have your escrows in your mortgage if you're below 60% loan to value. So if you put a bunch of money down, you can choose that, but just know that sometimes your rate's going to be higher. So if people ask me that, I always say, okay, you're going to have a little bit higher rate, but you can do that if you want. Usually they don't want a higher rate. Vanessa says when you refinance, it's the 60%. No, when you refinance, it's just the 20% down. I was talking about the escrows. Sorry, not mortgage insurance. Did I confuse everybody? Yeah, so 60% usually, and sometimes I just have to run it and see if the rate goes higher. And in this recent case, the rate was higher, and so they decided not to do it. Okay, so ways to remove mortgage insurance, we talked about that. Go on to seller concessions. We talked about this a little bit. Let's just go over this one more time because it is kind of hard to remember and a little bit confusing. But seller can pay up to 6% on government loans. So FHA, VA, and USDA. VA says 4%, so be careful with VA. Seller can pay up to 3% on conventional loans unless you put 10% or more down, and then it's 6%. Again, on investment properties, max 2%. And what can these seller concessions go towards? I still have people ask me if this seller can pay their down payment. Can the seller pay any of their down payment? No. Can you, as their agent, pay any of their down payment? No. Every once in a while, you'll have a special circumstance where it's family and it's FHA, and we can maybe do some down payment. But for the most part, just kind of have that rule that sellers and agents can never pay the down payment. So, yeah, definitely that. So then you kind of max out, right? You might max out on closing costs before you max out on the max seller concessions, right? So go ahead, Lynn.
Can drug dealers pay the down payment?
I wish. I have so many drug dealer friends that I wish could pay my down payment. No. So we joke about this because when we're doing gifts or when we're doing money for the down payment, we have to source that down payment, right? So I have to figure out where that down payment came from. Sometimes we can't source, or like it's not sourceable, we call it, when it's either hasn't been in your account for long enough, it's cash, something like that. So we'll have earnest money sometimes that we can't source. And so then they can put that earnest money in your brokerage and it can hold the lot or the deal, but it's not on their CD. And so we have a couple deals right now that are like that. Somebody gave them the money and it's not a family member, something like that. Anyway, we just have to take that off the CD and they got to bring the money in and then they'll get it back after they close. But we laugh sometimes because we're like, if it's been in your account for 60 days, we don't care where it came from. It could be drug money, it could be whatever, we don't care. but it has to be in your account for 60 days. So I don't see it go in your account basically when I ask for 2 bank statements. Okay, a 1-1 buy down. I was offering this and I still can offer this, but basically it's a 1-1 buy down, either 8.8% off the fees or 1% lower interest rate for a year. Typically, when we have seller concessions, most people are just doing the lower fees to come in with less money, but that's always an option. I wanted to talk a little bit about 2-1 buy downs and 3-2-1 buy downs. We still have the ability to do these because we have seller concessions. These will go away when the market completely shifts and we no longer have any seller concessions. But we can do these. There was a lot of these done a couple years ago. And what were people telling buyers? Do this and get into the house you want, and then you're going to be able to refinance. Right? You'll be able to refinance, it'll be fine. Now you have to qualify for this higher interest rate. So people were going a little bit higher than they were comfortable with, knowing or thinking, I'm going to be able to refinance and it'll be fine. What's happening right now? They haven't been able to refinance. So a lot of these things are coming due. I had a friend of mine call me the other day and she was like, I've got to refinance. My 2-1 buy down is going to end and I'm going to have to pay $800 more a month. And I don't want to, I can't do that. But she doesn't have enough equity to refinance yet. And her credit score is not as high as it needs to be, right? So anyway, this is kind of an interesting thing that's happening right now because people typically over every about 3 years, you end up being able to refinance and the rates dip enough that a lot of people can refinance. And we just haven't seen that this time. So there are some people who are really suffering who thought, okay, I was going to be able to refinance and I haven't been able to. So I'm not having as many people ask me about these anymore. And I don't know if it's because they've talked to somebody who's done them and they're scared. But a lot of people are like, I want to know my rate is going to be this and it's not going to change. So a lot of people don't even like to think about ARMs right now. Okay, we've done one word and we're almost halfway through. So let's do another word. Let's do refinance. There's a lot of people hoping to refinance, right? I think it was last year, maybe in September, maybe it was the year before, we had like maybe a week period where I did 2 refinances and then all of a sudden the rates were gone again. So you have to kind of really be ready and know what you want to do sometimes to be able to get that lower rate. Okay, let's talk about any other questions about loans. We're going to talk a little bit about the contract as it relates to lending. I think this is super important and fun to talk about, and it's helpful when I receive contracts and people understand kind of what goes into the contract that's going to affect their lending. So, but I'm happy to go back to loans types if anybody has a question come up. Okay, so we're going to kind of just talk about a lot of different things in the loan. Names on the Rep C and, lead-based disclosures and earnest money and lots of different things that can affect a loan and can affect how it goes, how the lending ends up happening. So making your life easier, making my life easier, I always like to go over this. Okay, so before writing a contract, know exactly who will be on the loan and put their names on the contract. I typically, when I send out a pre-approval letter, I make sure I have their names on the pre-approval letter the way they have it on their loan. And so then sometimes agents will put their middle name in there, sometimes they'll change it. Sometimes I've had them put it in there where it's a nickname. So ideally, it's the way that they're going to have it on their loan. Middle names aren't as big a deal, but sometimes we're going to have to get an addendum that states this person is this person if their name isn't the way that we need it to be. So I always like to have people just, if you see my pre-approval letter, that's how it is on the loan. That's the best way to put it on the contract. And then oftentimes you don't know or aren't sure about who the seller is. And so I'll see sometimes either people are in a hurry to make an offer or they just don't know and they'll put owner of record, which is fine, except for we're going to be getting an addendum stating who the seller is, which is fine. Usually we get another addendum later anyway. What about being on the loan versus being on title? So this is important maybe when you're listing, right? but there's a difference, right? So somebody could be on a loan and not own a home. When would that happen?
Cosign.
Cosigner. Typically, if you are a cosigner, you will own the home, right? You'll be on title. But there is one, Brad's right, where you can't be on title, and that's a Utah housing loan. And so whoever cosigns won't be on title. So that is true. You might be on the loan and not be on title. Good. But what about if you're on the loan and you don't own the home? Another one like that. You think of another time that that might happen.
Divorce.
Yep, yep. So, and Vanessa says right of possession versus obligation to pay the mortgage. So sometimes you'll be on the loan and it'll pull on your credit, and I'll have a divorce decree that says this loan is no longer belongs to this person and they're not responsible to pay it, and I can exclude it with the divorce decree. So there are some times where we might see that. That's more my side, but when you're oh, if someone sold a house on seller financing. So I think correct me if I'm wrong, but seller financing, you still own the home. You have, I don't know, is there a seller financing where you completely sign over ownership to somebody before they've completely paid you? I don't know. I wouldn't want to do that as a seller, but maybe there is.
I think if they assume the loan, that would be the only way that will work is if they assumed the loan. But generally, they kind of try to do it under the table.
And sometimes they do, Dallin, don't they add somebody to title, like they add them to title sometimes or put them on title? There are ways, an exclusive
Oh
deed.
yeah, they'll take their name off a title. So I just did one in Tooele, and my buyer's name's completely off title, and the investor's name's on title completely, and the name's still in my buyer's name or my seller's name.
Your seller's not on title at all anymore.
No.
Yeah, so that's interesting. Okay, so that could happen too. Good. And so then we're going to be proving stuff. Seller financing can be tricky. Just know that it can be really tricky when people, so for example, your sellers, Dallin, they sell this house on seller financing. Let's say that they're still on title, it pulls on title, and we're trying to offset it so they can buy a new one. They have to have 36, I had this happen recently. They had to have 36 months left on the seller financing contract to be able to offset it. And so they had to get an addendum to their seller financing contract because they were 1 month shy when we were going to close. And my underwriter wouldn't let them offset the seller financing deal. So just know that like if you sell your house on seller financing, there are times when hey, you need to buy it before 3 years so that you have an extension of 3-year term on your seller financing to be able to go buy another house and not have to count that one against you. Okay. Addendum removing or adding names, update. We aren't required to remove people from the contract if they aren't on the loan. So sometimes I'll see a contract between a husband and wife, but only the husband's on the loan. And I don't have to anymore remove the wife from the contract. But I have had a title company that we worked with that said you have to remove them from the contract. And so we ended up doing it because she would not tell, but I've never had any other title company tell me that I had to. So, let's see. And I think the title company's reasoning was that only one of them was going to be on title. And so if there were any problems, the contract was between both of them, but only one of them was on title. I don't know. Anyway, every once in a while we run into things and we say, okay, I guess. And then other times I really push back and say, no, that's not right, and go to bat. So one thing I did go to bat for with one of my buyers recently was counting property taxes off of the purchase price versus the appraised value. So we had always done it off the appraised value. And I had a buyer who it was a new build and his appraised value was 220,000 more than his purchase price. So I said, I don't want him to have to pay property taxes off that higher amount. The county only sees what? We're a non-disclosure state. So what does the county see when you record? The county only sees the loan amount. They don't even see the purchase price. And so I was like, we're doing their job for them already. And I don't want to, so it saved him $100 a month in taxes to be able to get that rule changed at our company that we could use the purchase price instead of always having to use the appraised value. So sometimes it's worth going to bat. Okay, double check the address with you. Make sure it matches USPS. That's what we as lenders are going to look for. So sometimes the listing agent has the address a little bit wrong. Sometimes the zip code's not right. Sometimes it is. Sometimes you look it up and it might be different, but I always go with the USPS lookup. Type it into USP, like if you Google USPS lookup, type your address in there, it should match. And then if we have any issues, we'll ask title to help us too, but that's what I go off of. Okay, lead-based paint disclosure. I found out today that whether you're buying a house that's built before 19, oh gosh, is it 78? It's on there. Before 1978 or not, you have to sign the lead-based paint disclosure. Everybody in Utah signs it. So I just learned that yesterday, so because my buyers were buying a house that was built in 2022, and they still had to sign this lead-based paint disclosure, even though they weren't buying a house that was old. So I didn't know that. But basically, we're going to have to get that disclosure as part of our loan if the house was built before 1978. And so you can either send it to us with your contract, or we'll just ask you for it either way. 1.2, this one now I know in the contract, at some point maybe we'll change our rules, but sometimes when you put something in the 1.2, like a trampoline or a shed or things like that, we'll have to get a 1.2 addendum that says that all those things are left with no value. It kind of says that in the contract anyway, I know. So I always tell people, my agents, to just like get used to in that 1.2 addendum, after anything you put in there, or sorry, in your 1.2 section, after anything you put in there, at no value. Just write those words in, then you never have to worry about if you need a 1.2 addendum or anything like that. Okay, I like to spend a little bit of time on an FHA VA addendum because there's a lot of things that can happen with FHA and VA loans that you want to be prepared for. So for example, we just did a VA loan. It just closed a couple weeks ago. Super great house, was a little bit older in a little bit older neighborhood. What about VA loan or VA appraisals do we need to worry about? Are they the same as FHA appraisals? What do you think? Dylan's shaking his head yes. Rolando says stricter. Okay, so they can be even stricter. Okay, good. Do they stick with the property the same way that an FHA loan sticks with the property for 6 months? Sticks with the buyer. Thank you, Julie. So that's what happened with us. So basically we had, and it does stick with that property and that buyer, but it doesn't stick for another buyer or another property. So basically I said to my agent, you can't just, we had it Tidewater. Everybody know what Tidewater is? If you hear Tidewater, that means your VA appraisal is coming in low. You don't know how low. They don't tell you what it's coming in at. You just know it's low, and you have 48 hours to gather some other comps and send them to the appraiser. So Tidewater, I'm like, okay, that's fine. We sent in our stuff, came back 90,000 low. That's a ton, right? We're like, wait a minute, how could this possibly be? So I talked to my buyer's agent and I said, you can't just go order another appraisal. Now with conventional, can you just switch lenders? Yeah, right. All day long, you can just switch lenders. Depends on where you are in the process, right? But if there's no issue, if there's no problems with that appraiser, meaning if they didn't make a mistake, like number of bathrooms, number of bedrooms, like that's the first thing I'm looking for on an appraisal that comes in low. Did they make a mistake? If they didn't, then with conventional, I can't just order another appraisal just because I don't like the appraisal. And I'm actually hearing whisperings of appraisers making comments like, well, somebody has to stop this market from continuing to increase and somebody's got to fix this. Okay, well, that's not their job, right? And so, but they have a decent amount of power sometimes in these situations, right? Because my buyer, who is a veteran, that VA appraisal stuck to his VA numbers and him as a veteran. He can't just go to another lender and order another VA appraisal because that VA appraisal stuck to that property and to him as the veteran. And so what we did was we had to do a reconsideration of value. Have any of you been a part of any of that before with a VA loan? It's quite exciting. So you want to have a lender who knows what they're doing, but basically you have to call the VA. And my underwriter kind of did it for us, but basically you just tell them we don't think that he valued this correctly. And we did get it to move up about I think it ended up being 60,000. We got it moved up. But really what ended up happening was is that he was looking at this property as a Q5 and it had been totally redone. So he gave it this Q5. It should have been a Q2, maybe a Q3. And so he was comparing it to all these properties around it that were in way worse condition than this property was. And so that's how we got it to go up and we ended up getting that deal finished. But it was a little bit scary for a little while. And sometimes those can take a little while. Ours came back pretty quickly, but sometimes those can take a little while. Okay, so there's not much you can do when an appraisal comes in low besides give new comps or try to see if they've made any kinds of mistakes. And I don't usually see them coming up in value. I did this time, which was really nice, but for the most part, they don't usually come up in value. Okay, let's talk about VA and FHA addendum. So you get an FHA addendum, and do you always send it with the contract? When you submit a VA off or a FHA offer, do you always send the addendum with your offer? Okay, Vanessa says yes. Yes, Ashley says, do you have to? It's kind of a trick question. Vanessa says no, and I would agree with her. So, do builders ever sign an FHA or VA addendum when you send the contract? A lot of times the builders are sending the contract to you. I know that. But do they ever send a VA or FHA addendum at the beginning? Okay, Vanessa says ethically not nice. Okay, so that's an interesting take. Again, not an ethics class, so you guys can decide your own ethics on this, but the builder does not. I've never seen a builder sign an FHA VA addendum before the appraisal comes back. Why? Do they want to give their builder money back? Do they ever give their deposits back? Not very often. But if the appraisal comes in low and they've already signed a VA FHA addendum, then you can back out as the buyer and they have to give you your money back. So I've never seen them sign it before the appraisal comes back. So fast forward, I had a deal last year that was an FHA deal. The buyer's agent sent another reason that you might not want to send that in is you don't have to technically have an FHA addendum. You can have what's called an FHA disclosure signed. So it's to do the loan. And so sometimes people feel like it's a stronger offer not to send that in at first because then it's not signed yet. And so they feel like it's a little bit stronger offer and then they can get that disclosure signed later and they don't actually have to have an addendum to the rep C. Okay, so that's what happened in our case. My buyer's agent had submitted an offer. She didn't submit the FHA addendum, but it did say FHA loan on my pre-approval letter. And we went under contract. We gave a full price offer with 20K concessions from the sellers. They came back to us around, it was only really a couple days after we were under contract, and they said, is there any other houses you guys would like? We'd like to get out of the contract. We have another offer that's better than the one that you have, that we signed with you. And so we'd like to get out of the contract. Can they get out of the contract just because they got a better offer? No way. No way. Could we have said, okay, we found this other house, we'll go there. I mean, the buyer has lots of ways to get out the contract. The seller's not so much. So then we were all super worried. I especially was worried because I was like, okay, we can't be in breach. They're not going to give us anything. They're not going to give us any due diligence. They're not going to give us any anything, right? Anything you ask, they're going to say no because then they can back out because they want to back out. So my first question was, where's the earnest money? Why? That was the first thing I looked at when I found out that they wanted to back out and that they were looking for any reason to back out. I didn't have a title addendum. So I was immediately worried, where's the earnest money? And is it at title? Because if I don't have a title addendum and the earnest money is at title, what just happened? My buyer's in breach, right? So if I don't have, if I don't have a title addendum, my eyes are watering. If I don't have a title addendum and my earnest money is at title, my buyers are in breach, and these guys can say, you're out, right? So make sure if you're going to put earnest money at title that you always have a title addendum, or else your buyer will be in breach. So, okay, the money was at the brokerage, so it ended up being okay. We weren't in breach there. But the whole time they would not sign this VA FHA addendum. They said we were in breach because we didn't submit an FHA addendum. They didn't know it was an FHA loan, and we were in breach and they weren't going to sign it. What do you think happened? Everybody got a little bit excited. Lawyers got involved and were consulted, but what do you think ended up being the decision? Let me ask it this way. Can a seller decide what a buyer's loan type is?
No.
No. So they couldn't buyers got it. So they ended up signing not an addendum. That would have changed the Rep C, and so we were worried that they might be able to come back. But just FHA disclosure at closing is what they ended up signing. And I'm sure they consulted their lawyers and we consulted ours. But at the end of the day, sellers cannot decide on what kind of loan a buyer does. And they also, they signed it at closing because if the appraisal came in low, they didn't want to give the earnest money back, right? They wanted us to back out anyway, so that was kind of a moot point. But anyway, super interesting and rough deal in some ways, because the whole time we were like worried that they were gonna, they were trying to make sure that we were in breach, and they were kind of thwarting our actions at every case. Yeah, it ended up being a new house, so we weren't worried about due diligence, but an interesting learn. So you don't have to submit an FHA addendum, even with an FHA loan. But if you know that they're going FHA, it doesn't hurt to submit that. And there are some times that it might feel like a stronger offer, even if it is FHA, if you just want to sign the disclosure at closing. So, okay. I personally, and you guys can think whatever you want, I personally don't like the idea of submitting an offer as conventional and then changing to FHA on purpose. So there have been times when we've done that, and it, they could go conventional. They decided to go FHA. They could go both. But if they really can't go conventional and you submit a conventional offer with a conventional pre-approval, I personally don't love that. But it does happen. Okay. Let's talk about repair escrows. This one's a big one, and typically when people are going into negotiations with repairs and due diligence and after the inspection, I tell them, okay, get it all decided and then bring it to me as the lender, and let's talk about how best to put it into an addendum, because there are some problems that can come by just putting repairs in addendums. Does that mean we don't ever want to see repairs in addendums? No, for sure. If you want something to make sure that it's done before you close, put it in an addendum. And just know that any repairs that are put in an addendum have to be done before you can close on that loan. And you'll have to get another addendum that states repairs have been done to the buyer's satisfaction and have everybody sign it. There's only a few instances where that doesn't happen. For example, like you might be able to get a repair escrow if there's the roof's under 2 feet of snow and it can't be done until later. There was a lot of repair escrows done on windows for a while when windows were really hard to come by and you couldn't get them for a long time. So there are a couple things like that. You can, have the seller pay for the roof replacement out of their proceeds, but that'll be paid, at closing, and it has to be done before you close. So there's a lot of different things. We'll talk about a few of them, but I think it's the best to negotiate repairs over the phone, via email, something like that. Then once everything's agreed upon, then put it in an addendum so that you're not negotiating over addendums, because I've seen it happen where addendum 3 says radon is too high, but seller to mitigate radon, and then addendum 4 says sellers won't mitigate radon. In lieu of radon mitigation, will give $1,800 in closing costs. What just happened if I get an addendum like that? What just happened to that deal? One addendum says the radon needs to be mitigated, sellers will pay. The next one says sellers will not pay, we'll give you $1,800.
The loan's finished at that point.
So either the loan's finished or somebody is paying for the radon mitigation to be put in before we can close. Right? So the better, like, I mean, either way, the sellers were willing to give the money, the buyers were willing to accept that. So that would have been a better negotiation over the phone, and then just place sellers to give $1,800 in concessions. Do we want to say for the radon? No, because again, then all of a sudden my underwriters were like, there's a radon issue. We need to have somebody go out and check that out. You're putting in a radon mitigation system again, right? But you can say $1,800 in concessions, and we don't need to know what it's for. Another
Okay.
thing I've seen is people reducing the purchase price for repairs. So for example, if the roof needs to be replaced, we're going to reduce the purchase price by $10,000. And then somebody puts in an addendum, purchase price to be $610 instead of $620 because the roof needs to be replaced. Now what just happened? The roof needs to be replaced or the deal falls apart, right? So just talking to your lender as you're learning those things, some of you have done it before. You might come across something you've never done before with loans, right? Though, and so it doesn't hurt to call your lender and just say, hey, this is what we're thinking about putting in there. Does that work for you? Does that cause any problems as far as lending? And it saves a lot of headaches. Okay. Any questions about that? Okay. Again, I want to make sure you understand it is okay to put repairs in addendums. Don't think that you can never put any repairs in. Just know that anything that's put in the addendums will have to be done before we close, or the buyer will have to sign off that they're done to their satisfaction before we close. Okay. Talked about this. Please make sure all pages are signed and initial. That's the first thing I do when I get a contract, is go through and make sure everything's signed, and every once in a while we'll have one that's missing an initial or missing a signature, and that's fine. We just have to send it back and get it done again. Also make sure that you know who the sellers are who are signing, right? So we have had deals where we don't have we have a trust as a seller or an LLC as the seller. We have to know that whoever's signing that contract has the right to sign. And typically a seller's agent, right, would have looked at those too. But we have come across times where we'll be like pretty far in the contract before we get the trust documents or the articles of incorporation, and we don't have the right person on the contract. So make sure as seller's agents that if your property is in a trust or an LLC, that you ask for those papers so that you're sure that the right person is signing the contract, so that doesn't have a problem later. It's a big deal in these. We were seeing a lot of divorces, and most people are having to sell their houses when they get divorced. It's just too expensive to buy somebody out right now, especially if your interest rate is in the 2s and 3s. Doubles your payment to refinance and buy somebody else. So we're seeing a lot of sales that way. So just make sure the right person is selling that contract or selling that home, especially if they've already gone through all the divorce stuff and it's settled who gets the house. Then you'd want to make sure that you have the right person signing. Make sure addendums are numbered correctly. no missing pages. Sometimes we'll have that where they're just not numbered right, and then we do an addendum to fix the numbering and stuff, which is not that big a deal, but that's something that I see sometimes. And make sure you're giving all the addendums to title and to the lender. Sometimes I'll have people who've negotiated and have an addendum, but they don't give it to me. So that's going to cause problems later. And could hold up closing because we have to, if it changes any of the numbers, we have to give it to the appraiser, have him update his appraisal. Then we have to send out the appraiser to the buyers to download, or we might have to go back through underwriting. So just make sure, even at the last minute, if you're negotiating anything, you let your lender know. Make sure the names are clearly spelled out somewhere in the Rep C. Sometimes, like, we'll have to get, like, you can't read the signature, and so we'll have to add something to it. So and so is able to sign for the LLC, or so and so is the signer of this entity or whatever, so that we make sure. I did have one where he signed with his, like, he didn't sign with his actual name. I can't remember now what his name was, but it was something like William, and he signed as Billy. And so then we were trying to get documentation to make sure that Billy was the person, right? And we just had to get an addendum that said Billy was William and that was the right person, and make sure everything was okay. Okay, earnest money. We talked a little bit about not being able to source earnest money. So can you put cash down as earnest money? What do you think? Did Jen say no?
Depends on the
Yes.
state you're in.
Yeah, so, okay, it might. Well, so in Utah, you can put cash down all day long. Can I use it in the loan? No. Right? But you can, if you have cash for earnest money, you can give cash. I had a lady once who literally, this was only a couple years ago, she took out 10 grand in cash and brought it to her agent. I don't know what she was thinking, but her agent was like, no way. She was like, we can't use 10 grand in cash. And she needed it. We couldn't have not sourced it. So she ended up having to put it back in her account. And then we had to explain it going out of her account and coming back in her account. And it was kind of a mess. So if, you can use cash, but it can cause a little bit of issues. If you're going to use it for the loan, you don't want to use cash for sure, because then we can't source it. So we have to prove that that money came from their account. We need a copy of the check. We need a copy of the wire transfer. How many days do you as agents have? Well, how many days does the buyer have to give the earnest money per the contract? Okay, Rolando, 4, calendar or business? Actually, 4, good. Calendar. Okay, so if you're coming on a weekend, be careful, count your days, because that you could be in breach if your client hasn't given their earnest money in time. So watch your dates on those. And then they have to give it to you, and then how long do you have to deposit it? 4, same. Okay, so 4 calendar days again to deposit. That's a total of 8 days. Do your lenders want you to wait 8 days to put money in the account? We hope you don't, because we've got to source it and get the documentation from our buyer. Sometimes we've got quick closes and we're working fast. So, but technically you do have that time. Okay, so again, if you're depositing, and you have to make sure it clears the bank. Good point, Rolando. What happens if it bounces? Has that ever happened to anybody? I know it happens sometimes.
You're in breach of contract.
You're in breach. Okay, and then that means what should you do as the buyer's agent immediately?
Tell the listing agent.
I agree. Yep. Tell the listing agent, let them know, get some extension on it for whatever reasons, get an extension addendum signed so that you can get that earnest money back. Oftentimes I've seen it where it's just a mistake. Somebody forgot to deposit the money, somebody, it hit the bank too soon, whatever. But make sure that they know so that that doesn't come back later and then you were in breach and you didn't tell anybody. Um, so additional earnest money. So, people are putting that in their contract, right? So, additional earnest money to be given to the sellers at this point, and there's a couple different places in the contract where you can do that. So I always check those spots. It can make it a stronger offer if you have half your earnest. I have one right now where half the earnest money goes hard at due diligence. So that can make a stronger offer, right? You got to be quick and know you're going to be able to get that loan done. And I want an acceptance before due diligence at that point, right? Because I want to make sure that nobody's earnest money is ever at risk. Okay. Whenever you have in your hand client earnest money, cash, check, or money order, state law and administrative rules require you to sign for receipt of the earnest monies. In addition, if you deposit that cash, check, or money order with the title company, make sure that you receive a deposit receipt from that title company. So you always want to make sure that you're protected. I think that's the biggest thing about cash is nobody likes to have cash and be responsible for cash. It can be a little bit tricky, but I've definitely seen people give cash as their earnest money.
So
Okay,
did you
another
have that woman that brought the $10,000 photocopy that money as proof?
she put it back in her account because she needed that money. And so I said, you better put that back in your account. We need that money and I can't source it if you don't put it back in your account. So yeah, that was kind of crazy. I actually had somebody who had $100,000 in cash just in their house. Can I use that for their loan? Sadly, no. So she had to put it in the bank and then we had to wait a couple months, right? So mattress money does not work. You're going to have it be in the bank for a couple months. So you got to plan ahead. Okay, bare wood. FHA is not going to like that. Every once in a while, we'll see they don't like peeling paint. So if you make an offer on a house that has peeling paint and you're going FHA, know that that peeling paint is going to have to be taken care of most likely. Um, any safety issues are going to be called out, but they're also going to be called out in conventional most of the time. So, we like to look at FHA as way harder, but really in reality, they're pretty good, but there are some properties aren't going to go FHA. And oftentimes the seller's agent knows that and they'll just put conventional and cash on those properties. But again, anything egregious like a roof or holes or appliances that don't look or water that don't, conventional is going to call those out as being required to be replaced. Another thing that I've been seeing a lot, so as you're listing properties, if you look at the water heater and it doesn't have two straps, almost always the appraiser is calling that out. So you might as well just put that other strap on when you're listing the property. And then that just saves money for the buyers because it costs an extra $150 for the appraiser to go back out again after they do the first appraisal. Okay. Okay, so let's talk a little bit about issues with the home, Utah housing. If a client is going Utah housing and there's a second kitchen, what happens? They're not going to be able to go Utah housing. Okay, so second kitchen, second water, like it basically becomes sort of a duplex and Utah housing doesn't allow that. Okay, they could have like another space, but once there's a second kitchen or a second, what do you call that? Like utility, um, meter, then it's not going to be able to. So you can't have a second utility meter and you cannot, an appraisal can't note rents. So you might have a second kitchen that's not an actual apartment, like a mother-in-law apartment or something like that, that's not closed off, but don't expect to use the rents from it, which we're going to talk about ADU rents, and a lot of people are trying to find ADUs to be able to qualify and afford housing. So yeah, if the MLS lists rents, or if the appraiser notes rents, we're not going to be able to go Utah housing. So just be careful on that one. That usually people understand that. I like to talk about HOAs because helping your clients understand when they're looking for a home, the HOA cost is super important. I have had, borrowers who didn't realize, oh, there's this big transfer fee that I'm going to have to pay. And most of the times the sellers are paying it, but I'm seeing in almost all contracts. But if people want to have a really strong offer, they'll usually say that they'll pay them. But they can be pretty high, 0.5% of the loan or the purchase price. So just make sure that people understand and make sure that they've read through their CC&Rs too, that they at least get a copy of those when they're buying a place that has an HOA so that they know what they're getting into. That'll help you later. They won't be surprised if they can't park their car a certain place or that they can't have anything in their front yard or all the things that HOAs can be a little bit testy about. So when we have an ADU, this is a big deal right now. People would love to have an ADU to help them make their big payments. And so when you have an ADU, the biggest requirements are that it's in an area. It doesn't have to be permitted per se, but it has to be in an area that allows ADU rentals. A lot of places allow ADU rentals, especially if the owner is living there. So if it's a primary residence with an ADU rental, then a lot of places allow those. And not everybody does when it's not a primary residence. So be careful if you've got investors that are buying those, just make sure that, because otherwise the appraiser comes back and says, well, only if you live in it, and then you have a problem. But 75% of those rents can be added to income. This is a little bit different than offsetting the payment like you do when you buy an investment property, but you can add that as income to help you qualify. And I've seen it often where they can qualify for something higher than what they otherwise would qualify for because they've got 75% of the rents, but their payment is actually lower once they subtract out the rents than it would be if they would have bought at the lower purchase price. Does that make sense? So it's kind of crazy and really cool to be able to buy a property with an ADU and be able to help with the payment so that people can feel like they're more comfortable with these bigger payments. Okay, something that happens sometimes, and you maybe wouldn't know as the or as the buyer's agent, is because sometimes the seller's agents don't know, this happens a lot of times with flips. If they purchased it as an FHA loan and then they're going to flip it to another FHA loan, there has to be 90 days in between. And so sometimes flippers will try to sell it and they don't notate that it can't go FHA. And then you might be under contract and you can't go FHA. So just know that rule about FHA to FHA. If you purchased it in the last 90 days, you can't go FHA. It would have to be a conventional loan if you wanted to sell it before the 90 days. The number of days are calculated from the time the seller went on title to the Rep C signed, not the close date. So sometimes that gets confusing too because people will go under contract and then they're like, well, I'm not closing before 90 days. Well, it's when you signed the Rep C. I had one time where we had to redo the whole Rep C so that it would work because it was signed too early. FHA no longer works if seller acquired within the past 90 days. It used to, but they did away with that exception. So yeah, so basically you can't, FHA to FHA, it can't be within 90 days. That kind of is confusing the way I worded that. So conventional loans should be fine as long as the appraisal comes back solid, right? Because usually they're trying to get more money out of it. Seller may need to be prepared to prove how much they paid for the property and document repairs. So that could be asked for by the FHA appraiser, but that would be on the seller's side. Okay, new construction. I like to go over new construction just a little bit. I know you guys are probably doing a lot of new construction. I lose a lot of deals to new construction. Sadly, they're giving a lot of incentives that we just can't compete with, right? And so, but make sure that you read through everything with those contracts. They're different than the Rep Cs that you are used to. And you really want to make sure that you're protecting your clients by reading through those and making sure you understand everything that your buyers are signing to. Because most of the time, buyers aren't reading everything. They're signing and they're looking to you to say, is it okay to sign it? But on a new build, you're gonna need the COO, certificate of occupancy, and then you're gonna need the final inspection from the appraiser completed. So the appraiser will go out usually when cabinets go in, and then they'll come back out at the end to say, yes, everything's finished. And so we'll need those before we can close. And a lot of times those dates are kind of like, well, 10 days after final inspection or 10 days after C of O or, and so you just want to make sure that the buyer's lender is doing the things the way they should. And most of the time you're using the preferred lender if you're getting a really good concession from the builder. And so they should be good. Timing, There's lots of different timing things you have to worry about in the contract, but just make sure that you are checking with your lender and making sure that they can do what you're promising in the contract. Make sure you're working with a lender that can close quickly, because sometimes on deals you need to close quickly. So 2 weeks is a quick close, right? And you want to make sure that if you need that to be able to get that from your buyer, that you know your lender can do that. USDA takes a little bit longer. Sometimes that we have to send a file to the USDA, and then they have to do some things and send it back. So VA takes a little bit longer on the appraisal. They tell us 10 days. Sometimes we get it back sooner. So there's just some certain products that take a little bit longer. Jumbo loans are going to take a little bit longer. We have an in-house thing that I've been trying to get the word out, that's a professional loan. So if you have any buyers who are professionals and make more than 250,000 a year, we have a loan that can't be beat. It's been shopped everywhere, and it's in-house with CC Bank, our parent company. So if you have some professionals, I'm doing one for a doctor right now. They're kind of like doctor loans, only we've expanded it to like pilots and engineers and some of those other professionals. But I have a doctor that's buying 1.20 down, only 200 and something dollars in mortgage insurance. So he's just got his first contract, and he's closing a couple months before he starts his new contract. So some really good loan products. If you have somebody that fits in that, keep that in the back of your head and call me if you have anybody that fits that. Closing costs, typically 2 to 3% of the loan amount or the purchase price. That's a good rough estimate. What goes into closing costs? This is good to know, because sometimes people don't understand this, and I'm very interested lately with real estate agents telling their clients to shop lenders. I like the idea of knowing that you have a lender who's not going to overcharge somebody. But sometimes people spend so much time shopping a lender that they don't know how to shop them, right? So they get something from one lender, and then they get something from another lender, and have you guys tried to compare those? Like, it's even hard for me as a lender to look at somebody else's thing and then look at mine, and there isn't a one size fits all paper where you can just compare everything. So just be careful. I always like the idea of telling people, if you're going to compare lenders, just look at the rate and the lender fees. Because I've had people come to me and say, well, he says that the insurance is $50 a month. And so that saves on your closing costs, right? Because we got to add, for prepaids, we got to add a whole year of insurance. Well, if one person is estimating $100 insurance, another person is estimating 50, it's going to look like a lot better deal. But in reality, almost nobody's paying $50 for insurance right now. Insurance is higher. I'm estimating about $100 a month. Sometimes I get it a little bit lower, but most of the time it's about $100 a month or higher. So trying to be honest about what the fees are, I feel like, is super important, and spending time on shopping lenders is maybe not the best use of their time, especially when they're not comparing it the right way. So if you're going to compare and shop lenders, just look at the rate versus their fees. That's the part that I'm going to want to match if I need to match fees. The rest of it is just what it is. Days of interest will just be what it is. In property taxes will just be what it is. Insurance will just be what it is. Title fees will just be what it is. So comparing off the total closing cost doesn't always work as well as just looking at the lender fees versus the rate. Okay.
Question,
Yeah.
have you had any experience with these public infrastructure developments where when you go to the closing, there's either a second mortgage or a fee due up front to pay for the infrastructure?
On single family houses,
Yeah,
I haven't seen that. Has anybody else?
there was an article recently where, I think it was in Washington County, couple was closing on a house, and then at the closing, they disclosed they had another $10,000 bill to pay for the infrastructure. I can give you the title here if you want. It's Utah Public Infrastructure District Act, Title 17D, Chapter 4, Senate Bill 228.
Huh.
And
That's a big deal if that's happening, but I haven't seen it happen anywhere.
Well, and apparently, I did a little research on it, and apparently there's no requirement that that be disclosed prior to closing.
I work with developers who use public infrastructure districts. And typically those districts will have a monthly fee that will allow those um, infrastructure development fees to be paid over time. And they can be quite pricey. But that is right now in front of the legislature. And the legislature may disallow them. And there are some counties that do not allow that type of financing for public infrastructure as well.
I haven't seen that. So then are they required to let you know up front, or Dennis is right that they don't have to let you know till you're sitting at the closing table? I don't see how that would work because then you'd have to figure out that financing.
That's
I,
what
I don't I don't know what the law is, but I can tell you that we always disclose that with our developments.
Mm.
Now, this particular story, it wasn't disclosed until they were actually at closing.
Yeah, that's a big deal because then
Yeah.
you're like all the way down the road. So you would hope that they would disclose it sooner. Brandon says Black Rock in St. George has some crazy fees that are getting hit with. Is that in a HOA, Brandon? I would be interested. Yeah. So HOAs are a little bit different, right? Because they can just bring up fees later. Like you can get into an
Yeah,
HOA.
this is different than the HOA. This is specific to those special improvements that were allowed, but it was like thousands and thousands of dollars extra.
Yeah, that seems so unfair, right? They get you in there and then you got to pay it or you got to move, right? Or you have to pay it to move. So yeah, that's frustrating. So knowing about those things as a real estate agent for somebody who's going to buy in those areas is super important, right? Because you want to make sure they understand so that they're not frustrated later and like, you didn't tell me, I should have known this. Okay. Okay, so prepaids, whenever anybody talks about prepaids, 1 year of homeowners insurance, we're almost done here. I'll just go over this and then I'll give the last 3 words because I didn't even give the last 3 words. First year of homeowners insurance is part of the prepaids. 2 to 4 months of taxes and insurance depends on when you're closing, right? Because you got to fund your escrow account and then days of interest. So sometimes just realize like if you decide to close early, that's going to cost your buyer days of interest, right? And so we just have to, we want to, like, if you really are pushing to close early or the sellers are pushing to close early, we just want to make sure that we communicate with the buyer that's going to be an extra cost to them. So sometimes that works out and sometimes it doesn't. But just knowing all these different things is super important. And I appreciate you guys coming today. Feel free to call me anytime with any lender questions. I'm always happy to answer, even if I'm not part of the deal. Even if you're on the seller side and you're getting all these, you're talking to other lenders and you're like, hey, they're telling me this. What does this mean? I'm happy to be a consult. Okay, let's do our last 3 words and then we'll get you out of here so you can enjoy your Friday. Let's do FHA for our 3rd word. Okay, so this is our 3rd word, FHA. Let's do, oh gosh, you guys, what should I do? Security for our 4th word. So FHA is the 3rd word. Security is the 4th word. And then I always like to do Eden as my 5th word. Okay, everybody get your words? Okay, let's put up this one more time. Let me get all those emails out of the chat too before I end so that I can send you guys my matrix that you wanted. Thank you. Okay, you're free to go if you've set your words in. So either email, click on thanks, Thomas. Thomas just added that to the bottom of the chat. Click on that or scan with your phone and send in those words, and then you're free to go. Happy Friday. I'll stay on for a few minutes if anybody has any other questions.
Fifth word was just your name,
Yeah, my name.
the whole name.
Yeah, just Eden.
Eden, can you hear me?
Yeah.
Okay, great.
Melissa.
I tried before in the other class and you couldn't hear me, so I was
Oh,
like, I just will type. But so I just wanted to ask then, so the 60% is where you have a loan your home and it's 60%, then you can take escrow off?
Yeah, typically. So just make sure to ask because some lenders have different rules, but yeah, like if you're putting 40 to 50% down, then typically you can choose to have your escrows removed. And you can choose sometimes high, like with lower amounts. I don't think they'll let you do it with less than 20, but then your rate is increased. But if you have like 60% loan to value, then your rate's not increased. So like,
Okay, so it could also be the 20%?
yeah, but then
It
you're gonna
just
have a
depends
higher,
on,
yeah, you're gonna have a higher rate though. So most people
okay,
won't
because,
do it for the higher rate. Like, I don't know why you would, you know?
well, like if escrow is 700 something a month and then their higher rate, when they take that off, just makes their payment $200 more a month, I could see why they would do that.
But
But I just wanted to make sure I understood. So it just depends. So whether buying or refinancing, that's normally the rules. It could be 80%, it could be 60, depends on the lender.
yeah. Well, and it just depends on whether or not you get a rate hit. So like 60% you're not gonna get a rate hit, but like 20% you for sure would get a rate hit. But you still have to qualify with those and you have to come up with that money then, right? So if it's not escrowed, then in November you got to come up with all that money.
Right.
Yeah.
Which I'm totally fine with that. But I was
Yeah.
just asking because I prefer to not have escrow. It bothers me.
Oh,
I get the bill
interesting.
in the mail anyway, and it's like 1,700 or 2,800 for taxes, and I'm like, okay, great. But then I have these people charging me 700, 800 a month, and I'm like, what is this? Why are we doing
Wow.
this? Why am
Yeah,
I
so
stuck with
you
escrow?
don't have to pay the bill when it's escrowed though.
Yeah, but
But
I'm
it's
just
still,
like,
you don't like that feeling. Yeah. Yeah.
well, I'm just like, they take so much a month, and I'm like, I feel like 4 payments of this would pay this. Why I'm
Um,
paying all year? What is so? There's kind of a lack of trust there, but probably is based on lack of understanding. So that's why I was asking you about it because I want to figure that out. I'll probably come to you to
yeah.
do that for myself, and we'll
Okay.
see.
Okay.
Thank you though.
Yeah, I mean you can not have it and there is a like a slush fund of escrow. So there is a little bit of escrow extra in there. Like
Yeah, yeah. Someone told me once it was like a year extra, and it was just their safety thing or something.
it's not a year extra because you'll see it on the CD if they collect too much, they'll give you a credit back and there's like an actual calculation that they have to follow and everybody has to follow. So I know it's
Okay.
not a year, but it does feel like a lot sometimes.
All right. But thank you so much then. Have a good one.
You're welcome. Good to see you.
Good to see you. Bye.
Bye.
Is the mailing address a required field?
No. Does it say it's required? You can put dashes if you want.
All right. Thank you.
Welcome. Have a good day.